Good morning. It's Thursday, the 20th of February, and this is Govindraj Ethiraj, headquartered in broadcasting as well as streaming, as always, from Mumbai, India's financial capital, increasingly getting warmer. The take. There is always irony within irony. Just as President Donald Trump was expressing his displeasure over confidant Elon Musk's move to set up a manufacturing base in India in a television interview, tech giant Google said it was opening its largest and fourth campus in India on the edge of East Bengaluru with a seating capacity of 5,000 employees. Spread over 1.6 million square feet, the Google office, also one of the largest in the world, has been named Ananta, which translates into limitless in Sanskrit. Back to Trump, he argued in that interview that high tariffs create significant barriers for American businesses looking to enter the Indian market, forcing them to manufacture domestically rather than export from the US. If he, referring to Musk, built the factory in India, that's okay, but that's unfair to us. It's very unfair, he said. Tesla will set up a manufacturing base in India not out of choice, it appears, but because domestic policy, which has already been considerably twisted to favor the company, forces it to do so. Exactly like all the other companies who've come to India, beginning with perhaps Japanese Suzuki in 1981 with some help and Korea's Hyundai in 1996 without much help. Trump's tariff tirades are, of course, focused on manufactured goods, which are more tangible and also have a direct correlation to jobs or the perception of them. Though the cost economics are not all that clear, even if manufacturing were to be dragged back into the United States. A drug manufacturer told me that the cost of conversion of active pharmaceutical ingredients or APIs into tablets for an Indian company is a fraction of the cost for an American producer. He said he could not imagine manufacturing moving to the US, at least in this area, unless at substantially higher cost to consumers over there. But even as Trump continues to rant and rave at the world pulling out new tariff plans and threats from thin air, American corporations continue to lean on Indian brain power and talents to build and grow their global and American businesses. Google, which has over 10,000 employees in India now across 5 cities, says Ananta is one of its most ambitious ground-up developments. Increasingly, we have been building from India for the world, said Google. Now, Google is of course not alone. There are about 1,700 global capability centers in India employing over 1.5 million directly, and many more are being set up literally by the day, large and small, and many of course are American. Powering all of this is India's sheer workforce that represents 28% of the world's STEM or science, technology, engineering and mathematics workforce and 23% of the global software engineering talent. And all of this has obviously led to the setting up of more GCCs. Now, GCC is a general and specific term. For instance, Hyderabad is increasingly seeing GCCs in the life sciences space, given its own pharmaceutical manufacturing and research and development ecosystem. Many of these GCCs in India house global roles, once again, not in pure technology, for example, in healthcare companies like AstraZeneca and Novartis. Now, these are not, to repeat, traditional technology roles, but technology combined with other business roles, including in research-intensive areas like, as we were talking about, healthcare. Now, the rise of GCCs did not happen overnight and is not exactly breaking news, but a continuing testament to the limitations of the Trump view of economic control and domination. So while Tesla will try and export cars to India, a Google or Nvidia or Amazon or hundreds of other American companies have been embracing India and its talent and potential quite literally for decades, even without being asked. Google says the grounds at its campus featured extensive landscaping and walking and jogging paths, ideal for casual meetings and peaceful breaks. Perhaps the president should visit and spend some time in sync with the opportunity that India has to offer, rather, and see for himself how globalization has really delivered for America's biggest and best and continues to. The name of the campus, Ananta or Limitless, can apply to space as much as thought. And that brings us to the top themes and stories for the day. Are the markets circling the bottom even as they fight back? Standard & Poor's says limited impact of US tariffs on India as it is a domestic economy. China makes life difficult for Tesla cars in tit-for-tat moves. Rice stocks are at record highs and exporters want more curbs to be lifted. And salaries are still projected to rise in India even as attrition continues to fall.
This is the Core Report with Govindraj Ethiraj.
Are the markets circling the bottom? I said yesterday that this was like an IPL match, referring to trading activity of the previous 3 or 4 days. But on second thoughts, it's now looking like a bit of a test match with the batsman holding the crease at 22,800 and more on that number coming up. Of course, we've got used to seeing 4s and 6s in the last few years and some big wickets falling, but it was all fast-paced and promised to end in a day. A test match is slow and measured and runs over several days. The markets and the batsmen appear to be holding or fighting to hold on to their wickets and going for singles or not scoring rather than attempting big hits. They're, of course, losing ground, but not all that much. So the question, of course, is what is that base and where is this market holding at? Before we come to that, on Wednesday, the Sensex was down 28 points at 75,939 after the usual swings, which are increasingly difficult to predict, except that the downward pressure is quite evident. The Nifty 50 was down just 12 points to close at 22,932. And thus, this is a flat market or continues to be one, or to return to our cricketing analogy, not many runs being scored at the end of day's play. On the other hand, things look a little different if you were to be measuring the team's performance via the small cap and mid cap indices. The Nifty small cap index was higher by almost 2.5% on Wednesday, and the Nifty mid cap 100 was up about 1.5%. Bank stocks did well, while pharma stocks did not, thanks to that fresh round of tariffs threats from President Donald Trump, which included pharmaceuticals, distinct from all the other threats he has delivered in recent days. The pharma index fell to its lowest level in 7 months on Wednesday after Trump's threat of tariffs of about 25% or higher on pharma imports, according to Reuters, which also said that India's pharma exports to the US stood at about $8.7 billion in the last financial year, which was up 16% from the previous year, which also accounts for 31% of India's overall exports in pharmaceuticals, according to government data. Many top pharma companies, that's Indian pharma companies, rely heavily on the US for their revenue. Trump did say he wants to provide for some time for drug and chip makers, that's silicon chips, to set up US factories so that they could avoid tariffs. Meanwhile, Wall Street, quite inexplicably, given all this uncertainty, continues to hit new records, or Wall Street has better learned to ignore Trump's tariff threats till they actually materialize in the form of impact on stocks or financials of companies listed there. Stock futures were weaker overnight, but the S&P 500 on Tuesday hit an all-time high despite all those concerns of sticky inflation and trade uncertainty. The benchmark hit an intraday record of 6,129 and closed around the same level. Back home, the Business Standard pointed out that the recent market correction in India has seen shares of listed stockbrokers on the National Stock Exchange tumble up to 70% on the bourses. So the larger question to me is, where is the underlying or baseline of the market in terms of real numbers as well as sentiment? Is the market able to reflect positive developments in specific sectors or areas apart from the overpowering negative sentiment? How strong is FII's selling pressure on the overall sentiment of the markets apart from some of those other macro negatives weighing on market sentiment? I spoke to Gaurang Shah, head investment strategist of Geojit Securities, and I began by asking him how he was seeing the market and its ability to hold out and distinguish between the good and bad knocks.
So my understanding about the market is, number one, that you mentioned FI selling. Numbers are in public domain going. October 1st, 24 to 31st of December 24, FI sold somewhere close to about 1,60,000 crores. Beginning this year, 1st Jan 25 till day before yesterday, FIs have sold somewhere close to about 1 lakh crore. So after this humongous selling of 2,60,000 crore, markets have, I'm talking about indices, Sensex and Nifty has corrected close to about 12 or 14 odd percent. This is a positive thing that I would possibly predict. Speaking about stock specific and sector specific, yeah, there have been a little bit more downside moves depending upon which sector you want to consider. In terms of earnings visibility, now that there are curtains down on third quarter, one thing I can say is that the third quarter was color and shade better than what we saw in second quarter. Post earning press conference and commentary about the business outlook, one can possibly assume that the fourth quarter could be even better going forward from here. In terms of other news flows globally, Govind, the problem is that I don't think there is any such big, huge negative in terms of local news flow or the local situation. The problem is of imported, that is FI selling, commentary from President Trump in terms of tariffs, and of course, a little bit of negative sentiment on the rupee-dollar equation. After touching an all-time life low of 88, we have managed to stabilize a little bit on the rupee front as far as the dollar is concerned. There is pain definitely there in the market, but we are able to protect. I'm not saying that is a sacrosanct level, but we are able to protect 22,800. Last 4 weeks going, if you actually go to see, we broke 22,800 4 times. And each and every day that we broke 22,800, went below that, by the time we closed the trade, we managed to recoup that level of 22,800. Possibility of some kind of sideways move cannot be ruled out. Pain is there in large cap because FIs have yet not stopped selling and their holding largely is in that particular part of the market. Small cap, micro cap, we've discussed this earlier. There is still pain and possibly there is still more downside, largely in the small cap and micro cap universe. Mid cap could see some more selling pressure, but there are some stock and sector specific ideas that you can look at in the mid cap universe. Flows in terms of mutual fund, I don't think we have seen any kind of downtick over there. In fact, I was reading a report that in the month of Jan, small cap, mid cap funds saw large flows coming in. That means risk on is still there with the retail investor. They are not getting scared or they are not running away from the market. Go with. So it is a matter of time. We were used to higher double digit return 2022, 2023, early 9 months or so in 24 till September 30th, 24. And then the FI selling started. So I don't think there is any kind of fear or any kind of care in the market. It's only to see a little bit of more clarity in terms of policy decisions from the US and, of course, the flows from the foreign financial institutions.
Right. So, therefore, you're saying that while there seems to be a natural resistance in the market right now, going by the number that you used of 22,800 for the Nifty, but does that also mean that if there are, let's say, specific positive news, I'm not on the negative right now, but the positive news in a certain sector or a set of stocks, the markets will reflect that? I mean, are they able to overcome that sense of, let's say, are they able to overcome the pressure?
One sector that happened to be in the spotlight today, defense. There was some news flow about higher spending and more focus from the government side on the policy for the defense sector. Some of the stocks rallied almost about 5 to 10%. So market is willing to take both negative and positive. When it is negative, the sector or the stock gets hammered. And when there is positivity, there is equal amount of focus in terms of buying activity. And not to forget, defense rallied fantastic over the last year and a half too. And these defense related stock have corrected from the peak by almost about 40-50% or more. Yes, I will agree with your view that market is willing to give attention to news-based positivities or positive news flows for a particular sector or a company.
And if you were to look back in history, as in previous cycles, do you think that this reflects a mature market, a market, a mature market which is going through transition, mature market which is under pressure, a mature market that is perhaps still on the way down? Are you able to relate that to any point in the past?
I would say a mature market which is willing to fight out. I would put it that way. Go with this. I say with a lot of responsibility. Our company, Geojit Financial Services, we are actively involved into conducting investor awareness programs across India. I lead it from the front. I just got back Sunday from a 5-day trip to the state of Tamil Nadu. I visited Coimbatore, I visited Karur, Tirchi, and Shivakashi. And even before that, Govind, whatever interaction I had at ground level. In the last 5 years, where does the market mature from? Market matures from the maturity of the participants. And this large base of retail participants, they've got, especially in the last 3 years, post-COVID, the retail investor has matured to a great extent. They are not running away from their SIPs. They are not running away from committing additional capital in case if they have investable capital to invest in. They're not running away from that. So a maturity of a retail investor would translate into the maturity of a market.
You feel that people have this sense of maturity. One is, of course, because of age and having seen some cycles, but you feel that this is because they've understood or they believe so much in the potential of the market, or they have no choice?
They have a choice, but the choice is limited, right? You have a limitation. Like a common Indian investor would have 5 choices according to me: equity market, bank FDs, PPF, gold, and real estate. These are the 5 common. I don't want to go into Bitcoin because I hate that particular asset class. It's here and present danger to me. And it's not recognized in India. Correct me if I'm wrong, Govind. So out of these 5 asset class, in other than equity, gold, again, you get return in 3 years, 5 years. Real estate, you need a big ticket to invest. PPF and bank FD, you get return, but it is not enough after you deduct inflation and tax. So the only asset class left out is equity market. So people are willing to take that risk now, Govind. And like I said, my interaction tells me that this retail investor is going to stay here for a long time. And we are going to have an increasing base in terms of retail participation coming.
I know you travel a lot and all over the country talking to investors like this. Any from this trip, the one that you refer to, any anecdote or story or something that stood out for you?
A lot of them were confused in terms of whether to choose direct equity investment as a choice or whether to opt for a very disciplined and a very matured way of investing, that is via mutual fund SIPs. So I could only answer them in a single sentence, and that was that look, if you have time and capability and understanding about equity market, you can do your homework, select your investment ideas after due diligence, then you are most welcome. And if you don't have the time, if you don't have the capability, if you don't have that kind of knowledge, then please opt for mutual fund SIPs. But one thing was very, very clear, Govind, that despite of this correction, even in certain business news channels that I appear and I do the scholar shows, Govind, the question is, should I sell this stock? The question is, if the stock is fundamentally sound, should I add an average? And that's the kind of question. So that's the big difference that I'm talking about. And the anecdote is that people were wondering whether gold as an asset class, even at these levels of 86,000, whether it is viable to invest. So I also said the one thing, look, before notes and coins were there, historically, gold was the only medium of exchange. Gold was, gold is, and gold will always remain a precious metal. And a lot of uncertainty in the current situation around the world will drive gold prices to another level. So a very simple simple product is available, Govind. You choose gold mutual funds or you can choose gold ETFs, exchange traded fund. So my advice to them was that at least out of 100 rupees, please make it a point that you invest 15 to 20% of that investable amount into gold asset classes, so that they're mature enough to realize that, even at this prices, gold is not expensive.
Gaurang, thank you so much for joining me and sharing your thoughts.
Always a pleasure, Govind. Take care. Bye-bye.
Standard & Poor's says Impact Limited. Standard & Poor's global ratings on Wednesday said the impact of the US reciprocal tariffs will be limited on India as the economy is domestically oriented with less reliance on exports. It also said in a statement reported by Business Standard that India will clock between 6.7 to 6.8% gross domestic product or GDP growth over the next 2 years. An official said the fiscal 25-26 budget will boost growth for the next few years thanks to domestic demand through tax cuts for households and GDP growth is now normalizing to a more sustainable level. He also said that they anticipate that consumer spending and public investments will maintain real GDP at around 6.7 to 6.8%. While these rates are slower than before, they still place India above sovereign peers at similar income levels, and they believe that this will continue to support fiscal revenue growth despite the income tax cuts. S&P also said that India's dependence on exports for growth is not that great, so while the impact of US tariffs will be more or less limited, sectors which could be exposed to higher tariffs are jewelry, pharmaceuticals, textiles, and chemicals. However, they said that US may not impose very high tariffs on pharmaceuticals, just as Indian domestic producers have been telling the core report, which are basically generic drugs, as it would drive up healthcare costs in their own country. However, textiles and to some extent chemicals are most at risk of higher tariffs. Trump's tariff tirade continues. President Trump on Tuesday said he was considering tariffs of 25% or more on automobiles, semiconductors, and pharmaceutical products. Tariffs will be in the neighborhood of 25% on those industries and may increase over time, he told reporters on Tuesday, and that they would go very substantially higher over the course of the year, according to the Wall Street Journal reporting that. He also said that companies in the US may be given a phase-in period on items they import, giving them time to move production to the US, which would allow a little bit of a chance to reshore production, though he did not provide any further details, according to Wall Street Journal. Last week, he had said that he would impose 25% tariffs on imported steel and aluminum, and before that, of course, he increased tariffs on Chinese goods by 10%. And all of this comes on top of the reciprocal tariff action that the Trump administration has already talked about. Meanwhile, among other geopolitical twists that increasingly make you wonder what were these guys thinking or smoking, Tesla is now facing potential delays in securing approval for its autonomous driving technology in China as the ongoing US-China trade war complicates its regulatory path, according to a Financial Times report quoted in the Business Standard. Tesla has apparently been informed that there is no clear timeline for obtaining a license to advance its full self-driving technology in the country. There is a lot of stock market price action also linked to this, that is of the Tesla stock. Anyway, Tesla had initially anticipated receiving approval in the second quarter of 2025 in what is a crucial step towards introducing its semi-autonomous features in China. The FSD system, just to give you a background, can accelerate, steer, brake, and change lanes, though it still requires drivers to remain alert with hands on the wheel. All of this would have given Tesla subscription revenue and also helped it regain momentum in the Chinese EV market, in which it is present through a very large manufacturing plant. India's rice stocks are piling up. India's stock of rice is piling up in the granaries. Exports of all types of rice have now been allowed after being blocked earlier, except for one category, that's broken rice, used for purposes as varied as food, to animal feed and ethanol production, which of course continues to be banned from export. The Rice Exporters Association in India wants this ban to be lifted to help manage stocks in the country as well as help buyers like poorer African countries, among other users. India's reserves of rice, including unmilled paddy, totaled about 67.6 or close to 68 million tons as of February 1st, compared to the government's target of 7.6 million tons, so almost 10 times, according to data compiled by the Food Corporation of India and reported by Reuters. I reached out to B.V. Krishna Rao, president of the Rice Exporters Association, and I began by asking him how they were viewing this or why they were asking for this export curb to be lifted and how that linked to India's overall rice production and levels.
So, as you know, the background, what's all transpiring in the last 2 years, and subsequently we were able to get the white rice exports opened up, the duty removed and all. So, India is back into the international market. As you know, we occupy a line share. So, a disruption happened when we withdrew, and now when we are back into the system, the same reversal is happening. The prices have moved down sharply. So, I think the situation is now Vietnam has dropped the prices, Thailand, Pakistan, every prices have moved on. So India is also trying to find its place. The exchange is also helping us in a smaller way. So I think so the lost market share, to get it back, as you might be aware, right, it takes a little bit time. But we will be back on track, but with a lower numbers. I think we need to compete with other origins. So we are taking up seriously this issue.
Right. So somewhere in between September 22 and later in 23, all exports of rice were banned. Compared to then and now, how much are we exporting?
Yeah, if you have the previous data, before the ban, we are doing close to 18 million tons of parboiled rice. All rices put together. Then initially was a broken ban was implemented. Then white rice and parboiled duty was in place. So we are drastically from 18 million, we have dropped all the way to 8 to 9 million tons. And now with this removal of the restriction on this two major commodities, I think we will be reaching to the old benchmark figure, but it will happen over a period of time. Now we have started exporting close to 2 million tons per month. So that 18 million tons target should not be far off. So we are requesting government to open up broken rice also, which is an integral part of the milling process, which will help because when we mill, the miller has this broken in his hand and the buyer also requires this broken to service his lower end customers. So I think so broken and rice are integral part of the same system, ecosystem. So we have requested government once again to open up broken export, because ethanol people cannot afford broken rice, which is at around 28, 29 rupees. I think it is an edible grade. It's better to be exported because we are losing lot. $1 billion we can get by export of broken rice also.
So, how much is broken rice in proportion to overall rice production in India?
When you compare, India's broken rice production will be around 10%, the overall Indian production. And for export is also 10%. So we export 1 million tons of broken. We used to export to 1.5. Probably we will be something exporting between 1 million and 1.5 million, 1.5 million. So that will help us to liquidate, because miller also is getting stuck with the broken. So liquidity issue will be there for the miller. So we requested them, ethanol is having other sources of staples available for them. I think they should let go this broken rice.
Right. And in terms of overall rice stocks currently, the figure that I have is about 67 million tons of rice stock with the government as of February 1st. versus a target of about 7.6 million tons. So it's almost 10 times the target. Is that correct? And what is the significance of this?
I think the buffer stocks are way above the requirement. And the Rabi crop is also ensuing shortly in April. And the previous cargo procured in November, December of last year, it's still with the mills because they do not have space. The crop preceding this 2023-24, some of the crop is still with the millers. So I think the warehouse space, the delivery mechanism, you are able to buy, but you don't have the liquidity where you can sell, dispose so much of cargo. I think government rightly done opening up the export in September. I think broken is also one thing which has to be seriously considered before it is too late. Again, this adds up to the government stockpile.
Right. And last question. So if we are sitting on such high stockpiles, what should we be doing to reduce them? Because I'm assuming stockpiles cannot sustain for beyond a certain period of time.
Yeah. I think the delivery mechanism for the government is limited to the public distribution system. So more than that, I think the only way is to reduce the procurement. There's no way of increasing the distribution network because all of the people are having enough staple in the market. Maybe OMSs also they started releasing. I think if they continue that releases suitably, it may increase some availability in the market also, and the government may also be able to liquidate some of its stocks.
Right. Just let me sort of add to that last question. So at this point of time, India is exporting without any constraint or restraint all the rice that it wants to or can export. Is that correct?
Yeah, that's true. There's no restriction whatsoever.
Right. Mr. Krishna Rao, thank you so much for joining me.
Thank you, sir. Thank you.
Salaries to rise. Salary increments in India are expected to stabilize in 25 and set to rise by about 9.2% despite global uncertainty and softening growth, according to the annual Salary Increase and Turnover Survey 24-25 India by Aon PLC, a global professional services firm and quoted in the Business Standard. So that rise is a slight decline from the increase of 9.3% in the previous year. Importantly, the study says overall attrition levels have declined to now about 17.7% in 24 from about 18.7 in 23 and 21.4 in 22. The study also indicates that a trend of declining salary increments since 22, when companies had provided over 10% and close to 11% salary increases thanks to the Great Resignation. Salary increments are, of course, projected to vary across industries, with engineering design services and auto vehicle manufacturing budgeted for the highest increases, followed by non-bank financial companies, retail, global capability centers, and life sciences. Officials at Aon said that despite external uncertainties, India's economic prospects remain stable, with rural demand improving and private consumption maintaining momentum. They also said that the moderation in salaries is an expected outcome given the margin pressures on companies, and the sector-wise increment trends for 2025 reflect prudence and adaptability as companies balance market challenges and the need to attract and retain talent across sectors. The study is now in its 30th year and one of the largest and most comprehensive reward studies in India, and it looked at data from 1,400 companies across 45 industries, according to that report in Business Standard. That was the core report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.